I think from the opportunistic point of view, really it's the sectors that the banks regard as non-core and that really don't even pretend to understand them. So it's things that aren't offices, retail and logistics. Hotels, leisure, residential to an extent, and all the sort of, the businesses like pubs and self-storage and healthcare and those sorts of things, because I think in those situations the banks have more of a propensity to sort of say, do you know what, there's a portfolio of 500 million here or whatever, we are going to just push that out the door and we'll take the pricing that's available, because they don't feel they have a great deal of other options in terms of managing that process through. We haven't seen an awful lot of it yet, but I think that's probably, if you had to pick sectors where there's going to be more opportunity, it's probably those.
I think the point is, it's things where there's operational drivers where it's not a simple underwriting. I mean, these guys want, the banks, if they're going to provide leverage or they're going to stay in the position, they want something that's very simple, cookie cutter, fits in a box that they can take to a committee and get it done quickly. So anything with an operational element to it is going to be something where they're going to want to either divest or not want to do.
That's what we're finding actually, finding a lot of activity in hotels. I think one of the drivers is that the banks have to put more money into them to maintain the quality, because often the assumptions on the FFP reserve are insufficient. And their flexibility on enforcement is constrained because they don't want to bring operating assets, and particularly employees, onto their balance sheet.
And a number of them actually, a number of these were the first one to be restructured. So you look 2008, 2009, a number of them are coming for the second time to the restructuring committee, which isn't a good time to come at any point in the cycle. When someone remembers the name, it's not good. We sat there with a few. And in truth, partly, it's only in hotels, there is a very strong correlation between occupancy and GDP, and I think, frankly, if you ask any commentators in 2008, 2009, I'm pretty sure the GDP forecasts are very different to actuals, and everyone would have expected probably a 2 to 3% growth in 2012. I'm vaguely remembering that. I don't know the exact facts, but I think the GDP curve was looking very different. In truth, I think now it's widely accepted, so certainly the clients I'm talking to, that we're going to be bumping around the bottom for a while, and therefore, coming back to some of the discussions we had before on choosing on strategy, there is no obvious prospect or value improvement just by time. So the way you're going to do it is bring specific expertise, specific capex money, all of these things which for some of you as buyers will outweigh the differential in cost of capital. Because if you have a 20% cost of capital where you're able to generate value by just driving income or basically reconfiguring some of these estates, the fundamentals are, on the net basis, you may get to a level which is very competitive from a sales side perspective.